Hi everyone, my name is Erin Kelsey and I'm here with Adam Strauss and we're from Peek & Singer Strauss Asset Management. Today we're going to tell you a little bit about our latest quarterly letter which we've just published. So Adam, this quarterly letter covers a topic I think a lot of people have been thinking about recently. What happened in the stock market in 2018?
Well, 2018 was a terrible year for stocks. Stocks outside the United States dropped considerably, and stocks inside the United States also declined for the first time since 2008. In Q4, U.S. stocks were down 13%, and in December, U.S. stocks experienced the worst month since 1931 in the middle of the Great Depression. Stocks were down 9% in December alone.
So, in your view, why is this happening right now?
Well, in two words, quantitative tightening. Before I talk about quantitative tightening, let me explain quantitative easing, which is the policy that the Federal Reserve embarked upon between 2009 and 2014. What the Federal Reserve did was print money in order to buy safe investments like U.S. Treasuries and agency mortgage-backed securities, with the hope that that would keep interest rates down and nudge investors into more risky investments like real estate, stocks, emerging market, high yield bonds, and for the most part it worked. Financial asset prices increased significantly during that period of time. Then finally, in 2018, just last year, the Federal Reserve finally decided to reverse that policy through quantitative tightening. So unlike quantitative easing, where the Federal Reserve was printing money to buy bonds, with quantitative tightening, the Federal Reserve did just the opposite. They took the bonds they previously bought, sold them into the market, and then they take the money that they received for those bonds and extinguish that money. And what that does is it pulls liquidity out of the financial system. And I think that that was really the primary driver for a lot of the volatility and declines in asset prices that we saw at the end of 2018. And until the Federal Reserve reverses that policy, it's hard to see that not continuing. I think asset prices are likely to continue to be volatile until the Federal Reserve finally decides to end quantitative tightening. I don't expect that it's going to be very long before the Federal Reserve reverses policy, because the last thing that the Federal Reserve or the U.S. government wants to see is a recession caused by a significant decline in the stock market.
In light of that, how are you changing how you're thinking about investing right now?
Well, during this period of time, while the Federal Reserve is continuing to basically sell bonds out of its balance sheet, we're trying to be very conservative. So we're demanding a larger margin of safety before we buy new stocks. We're looking even more closely at the balance sheet of the stocks that we buy than we normally would. We're incrementally buying more treasuries and incrementally less corporate bonds, just so that we can quickly sell those treasuries if we need to in order to buy cheaper assets. And overall, we're just being a little bit more conservative until we see that the Federal Reserve is changing policy. And like I said, I don't think it will be very long before we see that change.
Great. Thank you so much, Adam. We cover all of this in a lot more detail in the quarterly letter, so I hope you will go to our website and check that out. Thank you so much.